Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Tyler Technologies, Inc., TYL. This is a company that, operates almost entirely beneath the radar of consumer tech.
Completely.
Yet it really forms the essential mission-critical foundation for public services pretty much across the entire nation.
That's right.
So today we're going to be dissecting their durable economic positioning, that painful but very profitable cloud transformation they're undertaking,
And it is painful.
and this massive, really forward-looking bet they are placing on AI that honestly could dramatically reshape their entire financial ceiling.
Yeah, and that's really the core conflict we're looking at. TYL is betting its durable public sector moat and high-value 1.7 to 1.8 times ARR uplift from customer cloud migrations will secure its long-term 30% plus operating margin target, justifying its premium valuation despite the short-term drag of sequential ARR deceleration and the emerging threat of AI-enhanced cyber risk targeting government systems.
Okay, that's a lot to unpack. So our mission for you, the listener, is to kind of move beyond those fluctuating quarterly numbers.
The noise, yeah.
Right, the noise, and to really understand if Tyler's long-term strategic vision, which is all about forcing this cloud adoption and pioneering AI in a market that's uniquely sticky
And defensible.
and defensible, can it genuinely justify the demanding multiples the market is currently giving this stock?
And we have to look at the execution risk, not just the promise, but the real risk in making these huge transitions happen.
Okay, let's start right there with that concept you mentioned, the durable public sector moat. Because this is really where the whole story for Tyler Technologies begins and in some ways ends.
It absolutely is.
When we talk about TYL, we're talking about a pure play, a specialized enterprise software and services provider that is 100% focused on the public sector.
Exclusively. They're not chasing Fortune 500 companies. Their world is local, state, and federal government. That's it.
And that specialization, it's not just a marketing gimmick, right? It's a deep strategic choice.
Oh, it's the bedrock of the entire investment thesis. I mean, this is a business that's built on literally decades of regulatory inertia and just deep behavioral specialization.
So what's their mission then?
Their core mission is to empower the people who serve the public. It sounds a little lofty, but what it really means is they focus on automating these mission-critical functions.
So things that absolutely cannot fail.
Exactly. Think about things like court dockets, public safety communications, 911 dispatch, property tax collections. They are just deeply, deeply embedded in those processes.
And the scale is pretty impressive.
The scale is astonishing, and it really speaks volumes about their market penetration. They have more than 45,000 successful installations.
Or 45,000.
Across 13,000 locations.
Yeah.
And that covers every single one of the 50 states,
Yeah.
plus some international clients as well.
13,000 locations. I mean, that's not just a big client base. That's ubiquity across American local government.
It is.
So why can't some generalist software provider, a big enterprise player, or even a nimble SaaS startup just swoop in and offer something cheaper and faster?
Yeah, that's the key question.
Where does that moat get its durability?
It really comes down to three things: complexity, risk, and integration depth. Government software is not like corporate software.
How so?
Well, it has to comply with these incredibly specific legal requirements that change not just from state to state, but even from county to county.
Things like zoning laws or tax code.
Exactly. Zoning laws, tax assessment calculations, judicial record keeping. A new competitor can't just build a generic platform. They have to understand and literally code decades of established, often really arcane law.
And the cost of failure is huge.
It's astronomical. I mean, if a city's ability to process warrants or dispatch an ambulance fails, people's lives are actually at risk. So a city council is always going to choose the established, proven vendor over some flashy startup.
So TYL's history, their track record, is actually a feature.
It's a profound risk mitigant for the client, which translates directly into extreme customer stickiness for the company.
That makes a lot of sense. Government decision makers, they prioritize stability and compliance over having the absolute latest features.
100%.
So to handle this huge specialized operation, Tyler organizes itself into two main segments. Let's break those down.
Okay, so the first and kind of the foundational segment is enterprise software. You'll see it as ES.
This is the heavy lifting.
This is the heavy lifting, the mission-critical back-office functions. When we talk ES, we're talking public administration solutions, the core ERP systems, courts and justice, public safety. It's really about modernizing the plumbing of government.
Hang on, let's pause on ERP for a second because that's a pretty dense acronym. For listeners who aren't in enterprise software, what exactly is a modern government ERP?
Right, good question. Think of an ERP as the central nervous system for a big organization. In a government context, it manages the city's money, its people, and its assets. So financial management, HR, and payroll, budgeting, procurement, asset management, like tracking all the city's vehicles and infrastructure.
And this is where they find a lot of their new business, right, in replacing ancient systems.
It's a massive replacement cycle. A perfect example is the city of Kenosha, Wisconsin. They recently picked Tyler to replace an in-house ERP system that had been running for more than 40 years.
40 years?
40 years. I mean, that isn't just old. That means the city was probably running on code that very few IT professionals today even know. It's a constant vulnerability.
So TYL comes in and replaces that with a modern integrated core.
Exactly. All that fragmented legacy infrastructure gets standardized.
Okay, so that's ES. 40 years of technical debt is a pretty strong tailwind. What about the second segment, platform technologies, or PT?
Right. So PT, this is more the digital interaction layer.
The citizen-facing part.
Exactly. If ES is the backbone, PT is kind of the face of the operation. This segment handles things like digital engagement, citizen portals, payment processing, data processing, and just better workflows for the agency employees themselves.
So this is how I'd pay my water bill online or apply for a permit.
Precisely. And what's really important is that TYL leverages its ES foundation to build these PT services. Because they already own the core systems of record, they can offer these uniquely integrated digital services.
And the volume must be huge.
The sheer volume is immense. The PT segment processes nearly 500 million transactions every year. They are a significant fintech player, just entirely within that public vertical.
So if you're the embedded plumber for 13,000 locations, this has to translate into an incredibly stable revenue stream. I mean, the government is the ultimate long-term customer.
Well, it provides a kind of structural stability that very few commercial software companies could ever match. Their whole model is based on these long-term government contracts.
And you see that in the financials.
You see it directly. In Q3 2025, their recurring revenues, so that's subscriptions, maintenance, transaction fees, that made up about 86% of total sales.
86%.
That level of predictability is exactly why this company gets a premium multiple. And on top of that, their client turnover is exceptionally low, which we'll get into. But it just underscores the point. Once TYL is in, they are virtually never leaving.
And the future of that recurring revenue, the high margin piece, that lives specifically in the SaaS conversion.
That's the critical piece of the puzzle.
Yeah.
It is the primary engine that's driving their margin expansion towards that 30% plus target they've set.
And that's growing quickly.
Very quickly. SaaS revenue, which is the highest quality, most predictable stream, grew 20% year over year in Q3 2025. It's at almost $200 million now.
And that growth is coming from two places, right?
Yep. New clients who just start on the cloud from day one, and critically, the conversion of their existing on-premise customers. That's what they call the flips.
And the shift, the flips, it's not optional for them.
No, it's central to their whole margin expansion story. It's the financial justification for their current valuation.
Now, speaking of strategic shifts, Tyler's growth, it hasn't all been organic. They have a really long history of M&A. I think it's something like over 60 acquisitions in 28 years.
Yeah, they've been very active.
How is that strategy evolving? Are they still just buying things opportunistically, or is it more calculated now?
It is definitely moving into a new phase.
Yeah.
I mean, management sees M&A as a core competency. They know how to buy and integrate software companies. But you're right, they've shifted from just opportunistic buying to what they themselves call a more proactive, intentional approach to M&A.
So they're not just buying what's for sale.
Exactly. They are targeting very specific capabilities to fill strategic gaps in their portfolio. They're often prioritizing companies that integrate really smoothly and offer a clear path towards either integrated payments or advanced AI opportunities.
And they have the money to do it.
They absolutely have the capacity. They were holding over $834 million in cash as of the last quarter. This kind of intentionality, it reduces the integration risk, and it really maximizes the cross-selling opportunity.
Okay, let's look at a concrete example of this. Let's dive into CloudGavel. What was CloudGavel, and why was it so important for TYL to buy it in November 2025?
CloudGavel is the perfect example of this gap-filling strategy.
Yeah.
So they acquired it in November 2025, and it immediately made TYL a leader in electronic warrant solutions.
Warrants.
Exactly. This acquisition directly strengthens two of their most crucial markets, courts and justice and public safety. It's all about addressing one of the highest friction, most time-sensitive workflows in the entire legal and policing world.
Right. I can just picture the old manual process paperwork, signatures, faxes, an officer driving across town.
A total nightmare.
So what specific measurable efficiency did the CloudGavel module bring? Because, government finance people, they demand a measurable ROI.
And the ROI here is just overwhelming, especially for public safety, where efficiency can literally save lives. The CloudGavel eWarrant module automates that entire cumbersome process.
The whole thing.
The whole thing. And it cuts the average turnaround time from when a warrant is submitted to when it's approved to just 27 minutes.
27 minutes? That's staggering. I mean, if I'm a local government official, I have to know what that replaces. How long did it take before?
It could often take hours, sometimes even days, especially if it was outside of business hours, when judges are harder to find.
Or if an officer had to physically drive the paperwork somewhere.
Right. So that 27-minute time frame represents a documented 90% saving over the old manual process.
A 90% saving.
That is the language that government sales teams understand. Reduce friction, immediate safety improvements, and freeing up highly paid police officers to do policing, not paperwork. It lets them prove that the investment pays for itself almost immediately.
That measurable efficiency is just powerful leverage. It lets them bypass a lot of bureaucratic hurdles, I'd imagine.
For sure.
And this tuck-in strategy, it wasn't just CloudGavel in 2025, was it?
No, 2025 was a pretty busy year for them on this front. They also acquired MyGov back in January, which does SaaS for community development, so think permitting, licensing, code enforcement.
Okay.
And then in July, they bought Emergency Networking, which specializes in cloud-native software for fire departments and EMS agencies.
And the genius of these smaller acquisitions is the cross-sell, right?
That's the whole game.
Yeah.
They immediately enhanced Tyler's ability to sell deeper within its existing 13,000 clients. If a city already uses TYL for its core financials, now they're a prime candidate for CloudGavel or MyGov or the EMS solution. It just enhances the lifetime value of that core government relationship.
Okay, this all sounds like a very strong, cohesive strategy. But let's pivot now to the financials that have caused some, let's say, short-term market anxiety.
Right, the deceleration.
Exactly. When you look at the recent numbers, critics have pointed directly to sequential ARR deceleration. Total ARR grew 10.7% year over year to $2.05 billion.
Which is still good growth.
It is, but that figure was a sequential decline from the quarter before. And that is usually a major red flag for a software company with a premium valuation. So why should investors ignore that signal?
This is really the critical point where you have to separate financial noise from a genuine signal of, demand weakness. And management is being very, very clear about this.
What are they saying?
They're saying this deceleration is the result of two major strategic, and this is the key, temporary actions. They are basically sacrificing some short-term headline growth to boost their long-term margins and revenue quality.
All right, so let's take the first counterpoint, the one that's tied to their main growth engine, the flips. How does moving a customer to the cloud, which is a good thing, actually create a drag on the reported ARR?
It creates what you'd call a nonlinear financial profile. So imagine a city has been paying TYL, say, $100,000 a year for 20 years to maintain their on-premise software. That $100,000 is recognized as high-quality, recurring maintenance revenue. It's in the ARR calculation. But when that city agrees to flip to the cloud, Tyler immediately removes that maintenance revenue component from ARR.
So the positive number just vanishes overnight.
It's gone instantly. But the new higher SaaS revenue, what they charge for the cloud version, it doesn't start getting recognized right away.
Why not?
Because the migration process, the customization, moving the data, the training, all that can take anywhere from 1 to several quarters to finish. So for a short time, Tyler books a negative hit to ARR as the old revenue disappears, before the new, much higher revenue kicks in later.
So that intentional removal is what's causing the sequential drag.
That's a huge part of it, yes.
Okay. That is the short-term pain. But what's the long-term gain that justifies that? I mean, how do they sell that massive price increase to the client? You're talking about nearly doubling the cost.
The magnitude of the gain is the whole justification. Once the flip is done, That transition generates a massive 1.7 to 1.8 times uplift in ARR compared to what they were paying before.
So the $100,000 becomes $170,000 or $180,000.
Exactly. And it shifts from maintenance revenue, which has lower margins, to pure SaaS subscription revenue, which is higher margin and infinitely more scalable.
But I have to push back on that 1.7x uplift. That's a huge price hike. How do city councils possibly swallow that? What's the justification?
That's a crucial point. And it really comes down to their sales execution. The justification isn't just you get the cloud. It's a full transition from a single software license to a comprehensive, fully managed service.
What does that include?
The customer gets, 1, guaranteed security patching and updates. They never have to worry about running old software again. 2, full disaster recovery and redundancy. And 3, they get access to all the new features and AI services that are only available in the cloud.
And they don't have to manage their own hardware anymore.
Critically, yes. They get to eliminate the cost of buying and maintaining their own servers, hiring network admins to manage them, and dealing with the physical security of data in the municipal basement. So the 1.7x uplift is presented not as a price hike, but as a reduction in total cost of ownership, plus a massive upgrade in security and features.
That reframing shifting from CapEx and labor to a predictable SaaS fee, that's a persuasive argument for a finance officer.
It is, and we know this transition is picking up steam.
We have visibility on that.
Strong visibility. In Q3 2025 alone, about $31 million in ARR came from new SaaS deals and flips. And the ARR from just the flips accelerated by a really robust 64% in that quarter.
So that's proof the strategy is working.
It's proof that the heavy lifting of the sales cycle is successfully accelerating the transition.
Okay, so that's the first source of noise, a temporary dip from a beneficial transition. What's the second strategic decision causing the decline?
That would be the Texas wind down. And this is a very deliberate action focused purely on improving revenue quality.
What is it?
TYL is strategically ending a large but very low margin payments contract they have in Texas. They are choosing to walk away from revenue that just isn't profitable in the long run.
You're telling me they are just shedding tens of millions in revenue. How bad was the margin on this contract?
It was basically commoditized revenue. The gross margin was estimated to be only around 10%.
Wow, 10%.
Yeah. In the software world, where you want your SaaS gross margins to be 70% or higher, a 10% margin contract is actively dragging down your corporate average. Management is strategically sacrificing that low-quality revenue now to boost the company's overall gross margins for the future.
So what's the financial hole they're creating by doing this? How big is the impact?
It creates significant top-line noise. The contract is expected to bring in somewhere between $39 and $40 million in revenue for the full year 2025.
Okay. But
that is expected to drop off a cliff. They're only estimating $4 to $5 million carrying into 2026. So they are intentionally removing about $35 million in annual revenue.
And that $35 million delta is what's masking the underlying high margin growth from flips and new deals?
That's it exactly. The decision is strategically sound, but it definitely makes the quarterly reports harder to read if you don't know the backstory.
So if the noise is this big, what assurance is management giving that the underlying growth is really there and will show up once these two drags are gone?
Well, they're providing very strong forward visibility. They're confidently saying that this noise masks the underlying growth. And they've already put out preliminary guidance for next year.
What are they projecting?
They're projecting SaaS revenue growth to be around 20% in 2026. And what's really powerful is how they break that down.
Go on.
They say 12% of that growth is virtually guaranteed, coming from current pricing and the already contracted backlog.
So that's already in the bag.
Pretty much. Then another 3% is projected to come directly from those accelerating flips we talked about. And the last 5% is what they expect from brand new bookings they'll sign in 2026.
So the majority of next year's growth is already de-risked and contracted.
Exactly. It lends a lot of credibility to their outlook for 2026.
Okay, this is where things get really interesting for me. Moving beyond the cloud transition into the future growth engine, which is artificial intelligence. Government agencies were often seen as, moving at glacial speed with technology. So how is TYL positioning itself to lead this next transformation with AI without completely terrifying the bureaucracy?
That's the challenge. And they recognize they can't just wait for government IT departments to get comfortable with, general AI. Their strategy is built around purpose-built AI.
Meaning
AI that's specifically designed to solve immediate, quantifiable public sector problems. They're focused on what they call a triple impact across 3 core pillars:
And what are those pillars?
productivity, decision-making, and service delivery.
Okay, can you walk us through those 3?
Absolutely. So productivity is the easiest, most immediate win. This is using AI to automate the repetitive tasks that eat up huge amounts of employee time data entry, routing documents, classifying forms.
The grunt work.
The grunt work. Decision-making is the next level up. It's using AI to process huge data sets, crime trends, housing applications, budget data, to provide optimized recommendations to human leaders. It moves government beyond just spreadsheets.
And the third one? Service delivery.
Right, that's the public-facing side. Using things like conversational AI or smart forms to make citizen interactions faster, less frustrating, and available 24/7.
It all sounds good on paper, but government procurement usually demands proof. Are they actually seeing measurable results from this already?
They are. This isn't theoretical spending. A great early example is a document automation solution they put in for Hillsborough County, Florida.
What did it do?
The system uses AI to process and categorize official documents, which is a notoriously labor-intensive task. The results showed 10 to 30% productivity gains.
Okay, that's solid.
But more importantly for government accounting, it showed a phenomenal 2 to 3 times return on investment. The key is that TYL isn't selling AI. They are selling the measurable ROI that the AI delivers.
But the biggest challenge in the public sector isn't always the tech. It's the funding. IT budgets are often stagnant. How do they plan to monetize this, and, where do they expect the money to come from?
This is probably the most brilliant part of their whole strategy, because it completely pivots the funding conversation. They are focusing on what they call agentic AI.
Agentic AI.
It just means AI that can act like a true digital workforce, capable of complex multi-step tasks. And the plan is to charge a predictable annual SaaS fee that is explicitly designed to capture a share of that measurable ROI.
Okay. Capture a share of the measurable ROI. Let's make that concrete for me.
What it means is the sales motion fundamentally changes.
Right.
Instead of trying to squeeze more dollars out of the already strained IT budget,
Right.
their sales teams are tapping into client labor budgets for these digital workforce tools.
Wait, you mean they're going to the HR and finance departments, not the CIO?
Precisely. They're going to the city manager and saying, look, you have 5 employees who just process building permits. Those employees cost you $400,000 a year.
Okay.
Our agentic AI solution can handle 75% of that workload for a $150,000 annual SaaS fee. You can reallocate or reduce 3 full-time positions, netting a $250,000 saving while also increasing speed and accuracy.
So they are reallocating labor spend, which is often the single biggest expenditure in any municipal budget.
It's a massive strategic advantage. It completely bypasses the slow, often political process of trying to expand a traditional IT budget.
That is a huge structural advantage, and it explains why they think they can still hit that 30% plus margin target, but it requires massive investment, right?
Absolutely. The commitment to building this future engine is undeniable. You can see it right in their financials. R&D expense saw a jaw-dropping 72% surge in Q3 2025.
72%.
Up to $51.8 million. And management has been very clear that 2026 is going to be a heavy reinvestment year with that elevated R&D and AI spending continuing.
So they're staffing up.
Staffing up, acquiring data, building those purpose-built models to make sure they keep their lead in this very specialized market.
Now, that R&D surge is necessary, but we have to acknowledge the financial risk that it brings with it.
You're right. While it's absolutely bullish for the long term, investors have to recognize that this massive intentional spending could limit near-term margin expansion.
And the market doesn't like that.
The market generally punishes margin contraction, even when it's strategic. So TYL has to manage this narrative really effectively. They had to convince Wall Street that this temporary margin pressure is the fuel required to get to that ultimate 30% plus operating margin target for 2030.
A target that wasn't achievable without this AI reinvestment.
Exactly.
So if AI is the future growth engine, we have to talk about the flip side, the critical counter risk it introduces. That's AI-enhanced cyber risk.
Yeah, this is a big one.
The public sector is a prime target for hackers because it holds so much personal information and controls critical infrastructure. How is AI changing the game for attackers?
Well, AI is basically the great democratizer of hacking. It lowers the bar for sophisticated attacks dramatically. It allows attackers to scale up social engineering tools that are almost impossible for a normal employee to spot.
So we're not talking about those old phishing emails with bad grammar anymore.
Not at all. AI lets them create believable, fancy emails. They can mimic specific agency formats, departmental jargon, even the communication style of a specific manager.
And the voice element has got to be even more concerning for government security.
It's terrifying, especially in a time-sensitive finance or public safety department. AI makes it possible to create convincing voice-generated phone calls that mimic trusted voices.
A mayor, a police chief.
Right. An attacker can clone the voice of a supervisor and call a payroll clerk, demanding an immediate wire transfer for some fake emergency. In a high-stress situation, that auditory illusion can easily bypass human caution.
So the security perimeter has basically shifted from the network directly onto the employee.
The employee is the weakest link, but the tools used to exploit them are now exponentially more sophisticated.
So how does TYL help its clients fight this new, really personalized form of attack?
The defenses have to become multi-layered and rigorous. The focus shifts heavily to continuous employee training and enforcing strict verification procedures.
Like what?
Like having a protocol that requires calling back on a known separate phone number to verify any voice request for a fund transfer, no exceptions. TYL helps by providing constant security training and managed security services because most local governments just don't have the budget for their own 247 Security Operations Center.
This brings us to a concept that's key to their moat, but maybe not fully understood. CJIS compliance. Why is that such a high barrier to entry?
Right. So CJIS stands for Criminal Justice Information Services. It's a non-negotiable compliance standard from the FBI for any system that touches criminal justice information.
Warrants, arrest records, court data.
All of it. The requirements are incredibly stringent. They cover physical security, personnel background checks, encryption, data segregation. The list goes on.
And if a vendor isn't CJIS compliant?
They are immediately shut out of the highest value contracts in public safety and the courts, period.
Yeah.
By maintaining this compliance, TYL essentially locks out competitors who just don't have the investment or the rigor to meet that standard.
And that applies to their AI as well.
Critically, when TYL uses generative AI, they have to guarantee that an agency's confidential data never touches an open public model. It all has to stay in a closed, protected environment. They have to emphasize that agencies must know exactly where their data is going. That trust factor is paramount.
Okay, we've covered the foundation, the strategic pivots, the financial noise, the future with AI, and the risks. Let's bring it all together for the final verdict.
Let's do it.
We've established that TYL trades at a premium valuation. Does the investment case here, this combination of an accelerating strategy and a uniquely resilient market, does it really justify that premium?
The bull case, it really rests on the unparalleled stability of their market position. You have high barriers to entry, decades-long contracts, and the mission-critical nature of what they do.
And that shows up in the retention rate.
It absolutely does. You see it in the almost unheard-of low 2% client turnover. That means 98% of their clients stay with them year after year.
And the financial future is getting clearer.
It is. Despite the short-term noise, the cloud transition is accelerating. We have that high-value growth that's visible into 2026, backed by that strong 20% SaaS growth forecast. They're making the right moves to get to that long-term 30% plus operating margin target. If they can execute on the flips and the AI monetization, then yes, the premium is warranted.
But no thesis is complete without looking at the execution risks. You mentioned 3 big ones. Let's go through them, starting with the unique risk of government litigation.
Right. First is litigation risk. Even with stable relationships, government clients are, sovereign entities. They can present very complex legal risks.
And TYL is dealing with one right now.
They are. They're navigating an unresolved $15 million lawsuit against a state government client seeking fees they believe they're contractually owed. Now, $15 million isn't massive for a multi-billion-dollar company.
But it's the principle.
It highlights the execution risk. Even when you're owed the money, the collection process can become long, expensive, and subject to political delays. It just creates unexpected financial noise.
Okay. And the second risk was about debt maturity, even though their balance sheet looks strong.
Correct. The debt profile presents a near-term pressure point.
Right.
They have a $600 million convertible note that's due in March 2026.
Which is soon.
It is. And because it's within 12 months, it gets classified as a current liability on the balance sheet, which always draws analyst attention. It's an execution issue, not a liquidity crisis, to be clear.
They have the cash.
They have the cash. They're holding over $834 million. They can repay it. They can refinance it. The expectation is they'll be essentially debt-free soon, but managing that March 2026 deadline is critical.
And finally, let's revisit the risk tied to their future strategy, that aggressive spending.
That's the reinvestment and margin risk. That heavy reinvestment year planned for 2026, driven by the huge R&D and AI surge, it's great for the long-term health of the company, but it will inevitably limit near-term margin expansion.
And that's the core communication challenge for them next year.
Exactly. Convincing the market that this intentional slowdown in margin improvement is essential to securing that long-term competitive lead and hitting the much better 30% plus operating margin target for 2030. If they failed to communicate that, the market could punish the stock based on quarterly margin performance alone.
So this whole investment thesis really hinges on flawless execution. They have to nail the cloud transition, keeping clients happy while pushing through those 1.7x price hikes, and successfully build out and monetize that AI strategy.
And if we just connect that to the big picture, you have to remember the context of their long-term goal. That original 2030 plan, the one that targeted 30% plus operating margins, it did not factor in the potential additive growth from AI. And given that the core of their AI strategy is to tap into client labor budgets, creating entirely new, massive revenue streams, it raises a really important, provocative question for you, the listener, to think about.
Which is?
If TYL successfully captures a meaningful piece of those deep client labor budgets through agentic AI, leveraging their incredible market access, how much higher is the ultimate ceiling than what that 2030 plan originally contemplated? And what is that new terminal margin opportunity?
That is the ultimate upside optionality for Tyler Technologies, built on a powerful combination of market stability, strategic margin expansion, and a new growth engine targeting labor spend. This has been an essential deep dive. Thank you.
My pleasure.
Risk defined, portfolio protected.